The United States is currently implementing sanctions, a form of economic warfare, which has significant implications for the dollar. In response, some countries are seeking alternatives to the dollar-based system. For instance, India is engaging in direct transactions with Russia. Holders of dollar-denominated assets are becoming apprehensive about the security of their investments in the face of potential seizure or similar actions. Historically, such scenarios have occurred before, and understanding past events is crucial. My own experience dates back to 1971 when I was working at the New York Stock Exchange. President Nixon announced that the U.S. would no longer convert dollars to gold, leading to a devaluation of the currency. Contrary to my expectations, the stock market actually rose significantly. This was a new experience for me, as I had never witnessed a currency devaluation before. A similar situation had occurred earlier, on March 5, 1933, when President Roosevelt made an analogous announcement, yielding a comparable market reaction. These historical insights, including studying the Great Depression, were instrumental in helping me and Bridgewater anticipate the 2008 financial crisis. Currently, as the global order faces challenges and one great power confronts another, the likelihood of conflict increases. There are 5 types of wars to consider: trade, technology, geopolitical influence, capital, and military. These conflicts drive nations towards self-sufficiency and independence, leading to a decline in globalization and a rise in nationalism. In terms of the stock market, the primary concern is the impact on cash flows. However, as conflicts intensify, the specific consequences depend on the nature of the events and the sectors affected. For instance, tech stocks may be influenced differently compared to other sectors. The most fundamental impact of these dynamics is on the value of money. Large deficits necessitate increased government spending on social programs, defense, and environmental initiatives, among others. When expenditures exceed earnings, governments resort to printing money to bridge the gap, which in turn devalues the currency. This scenario is reminiscent of the 2 currency devaluations prior to 1971, which led to the inflationary period of the 1970s. Consequently, the stock market's behavior is deeply intertwined with these macroeconomic and geopolitical factors. The stock market may rise and there are other considerations, but the notion that cash is trash becomes increasingly relevant. This realization dawns as people recognize that the bonds they hold yield negative returns, leading to a shift in the perception and value of money. Consequently, investment flows into alternative assets, fueling inflation and ushering in an economic environment similar to that of the 1970s. Historically, there have been 2 primary methods for addressing debt: repayment with hard money or soft money. Repaying with hard money often leads to economic depression, a pattern observed throughout history. Whenever repayment in hard money was attempted, it was eventually forsaken in favor of printing more money. This was the case in 1971 and again in March 1933. Given this context, it's crucial to reevaluate the value of money, particularly in terms of debt instruments. One must consider whether holding debt assets is wise, as they may become increasingly unreliable. The key is diversification, finding ways to allocate resources across a variety of assets to mitigate risks associated with any single type of investment, especially in a landscape where the value and stability of money are in flux. The current financial system is grappling with fundamental questions about the nature of money and the future role of the US dollar as the primary reserve currency. We're witnessing the emergence of alternative forms of money, leading to a competitive landscape where different types of currencies vie for prominence. This competition could involve cryptocurrencies, gold, or digital currencies like China's digital renminbi, RMB, each challenging the dominance of the US dollar. In this environment, it's crucial to consider the vast amounts of money stored in debt instruments and the diminishing returns they offer. This situation necessitates a significant shift in how we view and utilize currencies. All currencies are heavily burdened by debt. When we hold a currency, we essentially hold a debt instrument, implying that the value of these currencies will likely decline relative to other assets. While this decline is expected globally, the US dollar may experience a more pronounced drop compared to other currencies due to these shifts. We are already observing changes, such as increased usage of China's RMB and direct currency exchanges between countries like India and Russia, bypassing traditional reserve currencies. This evolution challenges the dual role of currency as both a medium of exchange and a store of value. The store of value aspect, particularly for the dollar, is becoming increasingly problematic, not just for the US but for other countries as well. Inflation rises as money flows into various assets, and with borrowing costs remaining low compared to the rate of inflation, there is an incentive to borrow more and hold fewer financial assets like cash and bonds. This situation points to a transformation in the very concept of money and the role of the dollar as a store of value. We are at the cusp of a paradigm shift, transitioning from one mindset and its associated strategies to another. Previously, the focus was on low inflation and the safety of holding bonds and cash. Now, as we navigate through this shift, there is a need to adapt to a new reality where these traditional approaches may no longer be as effective or secure. Companies traditionally haven't been overly concerned about holding larger inventories, nor have homeowners been particularly worried about inflation impacting their property purchases. However, when a paradigm shift begins, it triggers a reinforcing dynamic that can alter these behaviors. We've been in a 40-year bull market for bonds, where holding them was generally beneficial. But as this shift occurs, we start to see behavioral changes that further reinforce the cycle within the new paradigm. For instance, when there's a sell-off in bonds, it becomes inflationary in itself. This is not just due to the deficit but also because of the volume of debt being sold through these bonds. Consequently, interest rates are forced to rise significantly, or the Federal Reserve must intervene by purchasing more bonds. This situation then influences wage negotiations and settlements, contributing to the paradigm shift. This shift is occurring in a context of global conflict, which contributes to the breakdown of efficient systems. As countries strive for self-sufficiency to protect their interests, system efficiencies decrease, and this lack of efficiency becomes self-reinforcing. History has seen these patterns unfold multiple times. Raising the returns on bonds and cash, while tightening monetary policies, makes other assets, especially riskier or long-duration assets like technology stocks, less attractive. This creates a financial squeeze. As such, the changing dynamics in bond returns and cash valuation can have a profound impact on the broader investment landscape, particularly for assets perceived as riskier. Currently, interest rates are hovering just above 2%, which is significantly lower than the current inflation rate. We've seen inflation rates as high as 7%, and it's expected to stabilize around 5%. This scenario means that money value is eroding due to inflation. The challenge for the Federal Reserve is balancing inflation control with economic and market stability. Adequate tightening to combat inflation could excessively strain the markets and the economy. The dilemma arises when a nation borrows more than it lends and accumulates substantial debt. The repayment can be made either in hard money, which can lead to economic depression, or in soft money, which can devalue the currency. Reducing expenditure to manage this trade-off becomes increasingly challenging, potentially leading to a stagflation environment. In such a situation, the goal is to control inflation, but high interest rates needed for this can harm the economic environment. The issue is further complicated by the fact that one person's debt is another's asset. With rising inflation, the real value of assets like bonds diminishes. Considering the vast amounts held in bond funds and cash, the lack of return or even negative returns is concerning. The question then arises, will investors continue to hold these bonds in such an environment? The dynamics of this situation are complex and may be beyond the Federal Reserve's capacity to fully mitigate. They are constrained by these fundamental economic factors. Given these conditions, it seems likely that we may enter a period of stagflation, characterized by slow economic growth, high inflation, and high unemployment. In preparing a portfolio for such an economic environment, it's crucial to understand the dynamics of investments. Every investment essentially trades a lump sum payment for anticipated future cash flows. Thus, the cost of money and its return are key factors to consider. For instance, the decision to hold cash or bonds is influenced by these returns. Additionally, the expected returns on equities, calculated by discounting future cash flows to their present value, are equally important. In the current scenario, the projected returns on stocks are marginally higher than those on bonds, which in turn are slightly better than holding cash. This narrow margin questions the attractiveness of equities, especially considering their inherent volatility. It's vital to analyze the relationships between cash, bonds, and equities, and for businesses, the comparison between borrowing rates and potential earnings rates. However, an effective investment strategy should extend beyond traditional assets. Exploring alternatives that offer returns exceeding the cost of money is essential. The relative attractiveness of these instruments must be evaluated in the broader context of economic stability. Central to economic health is a societal belief in a fair system and the fostering of productivity. Paramount to achieving this is the redistribution of opportunities to enhance productivity across society. This approach is not only economically beneficial but also crucial in reducing internal conflicts driven by large wealth disparities and economic challenges. Such internal strife can have profound economic and social impacts. Therefore, in discussions about markets and economies, we must not overlook the significant influence of internal societal dynamics. Political considerations, especially in the context of wealth gaps and productivity issues, are inextricably linked to economic outcomes.